Welcome to The Explainer. Warren Buffett has that famous saying, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Well, today, we're taking that advice and applying it to one of the biggest stars in the entire market, the pharma giant Eli Lilly. So we're going to put it to the test. Is it a truly wonderful company? And, maybe more importantly, is it trading at a fair price? Let's find out.
First, just let this number sink in for a second. That is the total return for Eli Lilly's stock over the last 10 years. We're talking over 1,200%. A return like that doesn't just get your attention, it's the kind of performance that creates market legends. It's just phenomenal.
But as any long-term investor knows, what happened in the past doesn't guarantee a thing about the future. After a run-up this huge, you have to ask the hard question. Is this stock still a smart buy? Or is all the good news, and then some, already baked into that price?
To get to the bottom of this, we're not going to get lost in Wall Street chatter or fancy, complex algorithms. Nope. We're going back to basics. We're going to use a simple but really powerful checklist inspired by the core ideas of value investing. We are putting Eli Lilly through the Buffett test. Okay, so our whole investigation is going to follow these 4 straightforward but absolutely critical questions. See, a truly great investment really needs to check all of these boxes. So let's kick things off with the first and maybe most fundamental question of them all. Right, before we even start thinking about the stock price, we have to look under the hood at the business itself. Is Eli Lilly actually a well-run, super efficient, and highly profitable company? Let's see what the numbers have to say. Okay, this first number here is its return on equity, or ROE. And wow, almost 78% is just off the charts high. What this tells us is that for every single dollar of shareholder money that's put into the business, the company is generating nearly 78 cents in profit every year. That is just world-class efficiency. Next up, we have return on invested capital, or ROIC. Now, this is another fantastic way to measure quality because it looks at how well a company uses all its money, not just shareholder equity, but its debt, too, to generate profits. And a number close to 30%, that screams that this company has a strong competitive advantage. It's just incredibly effective at what it does.
And this number, this one is amazing. It shows their incredible pricing power. This is Eli Lilly's gross profit margin. It means that for every dollar of product they sell, more than 82 cents is left over, after you account for the cost of actually making it. A margin like that is the hallmark of a truly dominant company.
So, when it comes to our very first question, the answer is a huge, resounding yes. I mean, based on these key numbers, Eli Lilly isn't just a good business, it's an absolute profitability machine. It passes test number 1 with flying colors. But look, amazing profits right now aren't quite enough if you're investing for the long haul. A great company also has to be growing, and it needs to be financially solid. Which brings us right to our next test, looking at its growth and its debt. Now, this is what's so fascinating. Eli Lilly isn't just growing, it's actually accelerating. Check this out. The 5-year average annual growth was already super strong at over 21%. But in just the last 12 months, thanks to those blockbuster drugs like Mounjaro and Zepbound, that growth has exploded to almost 45%. This is the kind of rocket fuel growth that gets the market really, really excited. Of course, sometimes that kind of rapid growth can be fueled by taking on a lot of risky debt. A wonderful company can't be buried under a mountain of debt it can't handle. So what does its financial foundation actually look like?
The company's debt-to-equity ratio comes in at 1.6. Now, while that's not zero, for a massive business like Eli Lilly that just gushes cash, this level of debt is generally seen as pretty manageable. It's not a major red flag at all. So far, so good.
Okay, so we've established that Eli Lilly is a wonderfully profitable, rapidly growing company, and its finances look to be in pretty good shape. It's passed our first 3 tests, but now we get to the final, and let's be honest, often the hardest question of all, is the price fair?
And this is where our investigation hits a massive roadblock. The stock is trading around $884 a share, but when you use 2 standard valuation models, you get wildly different answers. Why? Well, because they measure different things. A model based on the company's current free cash flow, the actual cash it has left over, suggests a fair price of just $122. Very conservative. But another model, one that projects its future earnings way out into the distance, suggests it's worth over $1,300. This isn't just a slight disagreement, folks. It's a gigantic puzzle.
This leads us straight to Buffett's most important rule of all. Always, always demand a margin of safety. All this means is buying a stock for way less than what you think it's actually worth. It's your safety net. It's your ultimate protection against being wrong or just plain bad luck.
So, what is the margin of safety for Eli Lilly? Well, if we use that more conservative free cash flow number, the margin of safety is this deeply negative number. For a value investor, this is like a 5-alarm fire. It basically suggests the stock isn't just priced for perfection, but for a level of perfection that might be literally impossible to achieve.
So, let's recap what we've found. We have, without a doubt, a world-class business that's firing on all cylinders, a true champion of profitability and growth. But from one very important value investing point of view, its stock price is just floating in the stratosphere, totally disconnected from a conservative estimate of its actual value.
In the end, this whole investigation brings us right back to that famous Buffett quote. There is absolutely no question that Eli Lilly is a wonderful company. The numbers make that crystal clear, but the data leaves us with this final, crucial question. Is it being offered at a fair price, or is it at a price that leaves zero room for error? And that, right there, is the billion-dollar puzzle every investor has to solve for themselves.